Why is it not? Okay, now it's there.
I guess the YouTube version is going to be the uncut version.
Of
And
what
the-
you're gonna
and the
edit
audio
later.
will be like the
Should we start with
circumcised.
alrighty?
Wait, we already started.
Yes, we already started.
Shit.
But you can just go on. It's like no one is watching. We didn't tell anyone that we're.
I know. Yeah, but somebody might watch.
No one is going to be watching this. This is a new channel called Alan in the Market. No one knows about it. I haven't
Great.
made any advertisement or anything. So.
I know, but this is going to be uploaded and used and like appear on your channel.
Okay, should we introduce ourselves first?
You go first.
Okay, my name is Alan. I've been trading options. This is like.
We were just saying, you started when?
I've been trading options for over a year now, and I've been losing quite some money.
It's great how we can laugh about our failures. I think that's going to be the premise of this channel, because we're not trying to be gurus. We're not selling an ebook or a course or whatever. On the contrary, we are failing.
Yes, we're failing.
We're
laughing about it. We're having a laugh about it, which is good. So what about you?
But I started just after Christmas in 2024. So yeah,
And then it's quite a long time now.
Well, wait, when was Liberation? That was 25.
Yeah. Last year, April last year. I will remember
So I think
for
I
the
have,
rest of my life that back in day.
I think I have me too. We can talk about that more in a minute. I think I've got maybe 6 months more than you, but we're roughly at the same.
But you knew much. When we started talking about options, it seemed like you knew a lot about
Seems
options
like
already.
I think the reality of options is
Because you already knew
Maybe
all the
think you-
jargon, like poor man's cover call, and you were telling me about things like, for me, they were like, what the fuck is this?
But isn't that that's
Extraterrestrial.
one of the fun things about options? There's so much jargon. I love it.
Okay, so in my case, I think I started with options because I wanted to buy an American ETF that I could not buy being an European investors, because we're not allowed to buy American ETFs. And I just wanted the dividends. There were these yield max ETFs that they gave like 60 or 70% yield. So I was actually enticed by the premium or the yield.
How did you see that and not think this can't be for real?
You know when you want to believe.
know that
But actually, I was searching those things on YouTube. There were people. There was this guy saying that he was actually living off of the dividends of yield max and making like millions.
Oh, I think you sent me a video of his.
Yes, exactly. So I was thinking,
And he's
like,
a young guy, right? He's like, and he tell me about didn't he like mortgage his house? Or
yeah,
borrow-
and also the pension of his mother was
Wow.
also used for that. But anyway, so I was seeing those videos, and then also there were videos saying like, "Oh, this is a scam. Never buy yield max ETFs." But you know when you want to believe, and it's like, those people don't know anything. Let's just go with the guy who's making money. So I didn't listen to those ones. But anyway, so that's how I got into options, because I wanted to buy the ETF, and I said like, what can I do? I checked every single possibility, and one possibility was becoming a professional trader.
Okay.
You need to have like $500,000 and also like an expertise and a certificate and credentials for that.
Mhm.
So that was I
think
ruled
they
that
call
out.
that like sophisticated investor in some other jurisdictions, because I've looked into that as well.
Okay,
Because I followed this guy who was talking about
sophisticated. That
yeah,
sounds cool.
it does sound cool, but you have to have a certain amount of money, cash money, and you have to prove that you've got enough experience, and only then can you
And
invest in these-
credentials or something,
Right.
Like a certificate, whatever. That was not an option for
Right.
me, because neither have the money nor the credentials.
But options were an option.
But then someone said like, yeah, but you can do it through options, because if you get assigned by selling an option, you're forced to buy it. And then so I actually created the account of Interactive Brokers, and I just flooded the customer support service by asking the question.
spam them.
Yeah, spam them with all my questions, like, and are you sure I can do it? I'm still European. What if I get assigned? Do I have to sell them immediately?
Right.
Can I keep them? And then the guys were like, okay, relax. You can just you will be assigned the shares, and they will be in your account. You can sell them at any moment. Don't worry. Because then I was thinking like, what if I want to get rid of them? Because if I cannot make the transaction, if it goes both ways, I cannot buy them or sell them. When I get stuck with those shares. But you can actually sell them. You cannot buy them. That's the only thing.
But you can be assigned.
The funny thing is, because when I was looking at these regulations for European law, it says like it is to protect the investor. And I was like, oh, they're protecting me by not letting me to buy the thing, but I have to do this all the way around, getting into these options, super complicated way of.
I guess maybe the theory is if you're sophisticated enough to figure out a way to own them, then you're probably
fine.
Yeah, you're probably fine.
But that was not my case.
Were you fine? What happened to the Yield Max ETFs?
I
Were they as good as you thought?
no.
What happened to that guy
They
on
were
YouTube?
completely rubbish.
Right, because of NAV erosion, right?
We're
We're gonna get too into it.
Yeah. The thing is, they pay a dividend, but actually, if you look at the they give you a statement, right, of the dividends you're getting paid. It's a return, cash return, or your capital return, or return, whatever. They're giving your money back actually. So you pay $1,000 and they get your money back. That's the microphone.
I'm just checking that it's recording.
It is recording.
Yeah, we're 6 minutes in. Okay, fine. So
no one's watching, so that's fine. But they give you your money back. They don't give you. It's giving your money back. So actually, the share price is going down, and you get that money back every month. But you get less money that you put in.
Okay.
So in the end,
you do get a dividend as well.
The dividend, what they call dividend, is your money back.
I still don't understand, but okay.
Yeah.
Why do they give you your money back?
Because they call it dividend.
Right.
It
actually, sounds like a pyramid scheme.
It's a pyramid scheme. It's totally a pyramid scheme. It's a complete scam. So if you put $1,000, you get maybe $200 a month.
Yeah.
But then you get $200 a month, and that thing goes back. You think it should go back down to 100, right? But it goes down to 750.
Oh, and that's
then you lose it. Then they give you 150 then one, and then it goes back to maybe 600, and then every time you get less dividend, and the thing is less and less. Right. So in the end, you lose the money. Eventually, it goes down to 10, and you lose it.
Wow. But there's a lot of people on YouTube who are talking about these dividend ETFs.
Actually, there were more people talking how bad they are than the other way around.
Okay.
But I just found this guy who said he became a millionaire thanks to them, and
you wanted to listen to him,
and I wanted to believe. So it was.
There's so much like parallel between religious belief and doctrine and options trading, don't you think? We've talked about this often because your background is more, well, you're from the Latin world and I'm from the Anglo world. Or you could say you're from the Catholic world and I'm from the kind of Lutheran, Protestant sort of end of things. And how do those two worlds map into our trading styles, would you say?
Well, I pray. I believe and I pray.
I think we all pray.
I will get absolution in the end if I'm a good boy.
Okay.
So,
whereas
I don't need to work hard for it.
Whereas I'm thinking, if I just follow the rules, I'm disciplined, I can beat the market. That's essentially my bet.
Yeah, but that's not my case. I don't think I can beat the market. I think I can pray to beat the market.
Because the thing that I'm in love with is the idea of a kind of repeatable system that you can do week in, week out. And in the long term, it's gonna pay out, rather than a kind of scrappy, let's look at and see what's happening and try and figure out what to do at this point. I just want to have the rule and just execute it, because that's like the least brain power for me and cause the least anxiety. Has that worked out? You'll find out, I guess.
No, but see, I got into options. I got into options just because I wanted to get this ETF. I didn't want to get into options to do, because I had no idea you could do those things at that moment. I had no idea what what actually was. Well, I knew a little bit what an option was. Like a contract. They give you the right to buy something at a certain price. But actually, I had to sell a put, and I had to figure out what the fuck means to sell a put. Because I know what buying like a call option is. You have the right to buy, but sell a put is like I get the obligation to buy the share. It was complicated. And then looking on YouTube, I started to find out about those people that say retire on options trading, the wheel strategy.
The wheel.
And then with only $100,000, get retirement early.
Yeah.
Get $5,000 a month just by doing the wheel strategy safely.
The safe version.
And then I look at the options in itself, and I was like, "What the fuck is this?" And it's like, for me, it was like opening, the closet of Narnia.
Right.
And then you see this whirl, and then yes,
Pandora.
and then it's like, forget fucking Yilmax. What is this? And then I found these YouTube channels like Trading with Ashley, Money Talk with
No
Raksha.
Trade Left Behind.
No Trader Left Behind.
We like that.
And then
who else we got? Davis,
but there was this other one, Ryan. Options with
Ryan.
Ryan, the guy from California.
The guy I was obsessed with for a while. Oh, shit, what's his name? The one you dislike.
That I dislike? I don't dislike anyone.
I forget what his name. Henry, Uncle Henry. Young guy, always talking about how he worked for JP Morgan or one of those big banks.
Really?
Yeah. Anyway, he stopped appearing on my algorithm now because I've just stopped watching his videos.
But anyway, so those people promote selling puts, which means you will get the obligation to buy the shares. And by getting the premium, so you cash in those premiums, and then that you get your salary per month. That's the way you retire. So I started doing that. So I started doing those things because I already came from buying and selling leveraged ETFs on my European broker, the Giro. When I went into Interactive Brokers, I started looking for those ETFs in the American market. So it's the TQQQ, actually, which is the Nasdaq triple leverage ETF. So I started selling puts on those, and I started getting money every week.
What's that guy who does TQQQ? You know,
the one
with the southern guy.
Yeah, I know the one you say has like a.
Don't say that.
Don't say that. I forgot his name. Yeah,
what's his name?
He does many things, but one of those is.
Yeah, he does a lot of stuff. We actually like him. He's pretty sensible.
Yeah, I forgot his name.
But yeah.
But anyway, so I started selling those puts, and then what happened is like, if I'm getting like $100 with one put, what if I sell 10 per week? Then I get $1,000 per week.
I see why this is going.
And then Liberation Day came along when I was having 22 puts at 60.
So 22 times 60, that's
$120,000.
And you hadn't been assigned because the market was going up.
Exactly.
Right?
But then the market went down in 2 days.
And
Wednesday and Thursday.
What was the $60 underlying? Was it a leveraged? It was a leveraged ETF, so it's going to go up and down a lot more.
It went down to 30 or something.
Wow. Okay.
But I didn't know what rolling means or buying back the option or anything because I didn't know anything about options. So I had to ask for a loan and get all my savings into Interactive Brokers.
Okay.
And I got a big loan as well.
So you bought all of these shares at $60 and they're now worth $30. So you took out a loan for a guaranteed loss.
Yes. But that didn't go bad. That didn't go badly because the market went up in the end. So I could buy. I could repay the loan and sell those shares. And
did you?
Yeah, I did. In September I was playing again. So from
how long did it take?
September was hell, but by September I was
back to square one.
The square one, yeah.
And then
except for the fact that all my savings are now in Interactive Brokers.
I mean, I can relate to that. That's not a bad thing.
But that's how I got into options.
Okay.
And then, of course, right after Liberation Day and having to ask all those loans and stuff like that, I went into finding a course immediately on the internet, and I found this course of Locos de Wall Street.
Locos or Lobos?
Locos, crazy.
That's why I was just checking because it's like the wolf.
I know, but and I think it's like a wordplay in Spanish because it sounds like the Wolf of Wall Street, but it's crazy. So then I just got the whole course, the basic course and the expert course. So.
And now, do you consider yourself an expert?
No. I consider myself having done a course about experts.
Close enough.
But that's my story of options. That's how I started.
That's cool. I had a conversation.
But how did you know about options? How did you start?
Because I had a conversation with a friend who's into what's the Warren Buffett school of thought? It's called value investing.
Value investing. Yeah.
So he's looking for companies that are undervalued on paper, and then you buy the shares in the hope that the market will catch up the knowledge and the shares will go up. So my friend is really heavily into this, but he said to me, You know that Warren Buffett doesn't trade options, but he said it's where the most mispricing is in the market. And so that's probably where the most opportunity is. So I was like, that's interesting. So I started reading about options and also took a kind of a course. In reality, it was an ebook. Yeah,
I was
on how to sell
you're right.
put spreads. But you got to start somewhere. And then it's a rabbit hole because the world of options, it goes quite deep, doesn't it?
Yeah, that's what I thought. For me, it was like discovering Narnia. It's like, what is this whole universe that was hidden before my eyes? Because everybody's doing it, even on YouTube, and nobody knows about it. Because none of my friends knew about it. None of the people who also invest with shares and stuff, and also do value investing, knew about options. No one knew you could do those things.
And I think options has such a bad rap, right? Because it's considered high risk. Yeah, it's considered like something that's high risk. You can lose your shirt, which is true.
I don't think I'm contributing to improving the reputation. Just because I have this vlog where I say all the time losing money with options, and all my friends are like, "I will never invest in options."
Right. So are we brave or stupid or both? I guess. I think though, there's options and there's options. Like buying a call option. I mean, there's a lot of risk, I guess, in that, but
well,
it's all about risk management. I think options. You have to start as a risk manager, number one.
I didn't know about risk management when I started with options. Actually,
clearly.
I was just like, I when you put this carrot in front of a donkey and it just chase it,
right?
I was chasing that. I was like, okay, this gives me more money. Let's sell this one.
Well, that's the thing about selling puts. Starting off selling puts in an upward trending market. You never get a sign. All you do is just collect magic money.
And I started selling in the money puts.
Fuck, that's because it really ballsy, isn't it?
But that was a good. Of course, but it just went well. Not because it was a good strategy. It's just because I was lucky. Because I started with all these with this semiconductor leverage ETF called SOXL. It was at 14 at that moment. Right now, it's trading at 130.
Wow.
So I bought 10 calls at 14. And I financed those calls selling in the money puts at 30 or something a month out. And then it went up to 35. So those in the money puts, they were completely out of the money.
Wow, that was lucky.
I was very lucky. Because I got when I started with Liberation Day, SOXL was at the lowest. And it had been at the lowest for a few months.
So had you been waiting for it to go down?
And I was like, this has to go up.
Yeah.
Like I had a theory that, and this is what we're talking before, that you always have a theory behind, right? You always try to predict something. It's not about the system. It's about your...
you have a thesis.
You have a thesis. So my thesis was the semiconductors were going to go up. And I bought those calls. But of course, I fucked up when I started selling cover calls.
Okay, what happened then?
Because you sell cover calls and you cap your upside. So now I have cover calls at 57 of something that is worth 130.
Ouch. Yeah.
And I'm trying to, I don't want to release the shares. So I'm buying back those calls one by one.
Right. Okay.
So that's why I'm losing all the money I made.
Yeah.
Since the
beginning. They say, don't they? You're giving it back to the market.
That sounds nice. I'm giving it back to the market.
That's a psychological trick to make you feel less bad about.
I'm giving it back to the market.
Yes.
I'm giving back everything.
Speaking of giving stuff back, I had a similar experience where I was making quite a lot using this structure called the 1-1-2 trade.
Oh, I read about that.
Yeah,
It's like buy one put, sell one put, sell two puts or something.
You sell a spread. I can't really remember, honestly. But it was you. What do? You sell two puts really far out in really deep out of the money.
Out of money, yeah.
Puts.
Far out of the money. Two puts out of money.
Right.
Then one put in the middle. Out of the
Maybe
money.
you do a spread. That's it. You do a credit spread.
A credit?
No, a debit spread.
That's what I said. You buy one put close to the money.
I remember. Yeah.
Then you sell one put. And then
correct
to cancel that debit, you sell two puts out of the money worth the amount, and then you have a debit spread for free.
Exactly. Yeah.
So if nothing happens, they don't gain anything.
And if the market moves down a bit, you actually get more because it's like a kind of. I have to show you on the graph, but it's quite a nice trade, and there's such a huge window there of like potential movement of the price action that you are I wouldn't say guaranteed. That's what it felt like. It felt like I'm guaranteed to win. So each week or each month these were expiring, and I was like collecting my credit and thinking, this is great. So I'll do what you did, which is scale up. And instead of doing one contract on MES,
let's have 55 contracts.
Let's move to the next one up. Let's like make this bigger, so I'm getting like 1,000 a month from this thing rather than 100 a month, because like there's no more risk here. Why wouldn't I do that? Well, the thing that I didn't realize is that when volatility expands, those short puts become very valuable, and so to buy them back costs a lot, and then basically you've got a huge paper loss. So I had all of these 112 positions open, and then in this liberation day when volatility expanded, those all became really valuable, and so I got margin called and had to close all of these things and
at the loss.
At a huge lot. Like, so I wiped out 50% of my account in a day because
oh my god.
Yeah, because I didn't understand how volatility would affect this trade.
That happened to me. I was actually queuing in the supermarket in Mercadona. It was at a Thursday evening,
and you're looking
at and then all because I just checked my account. All my puts were out of the money. Everything was out of the money. Nothing was in the money or at risk. And then I get this little message from this notification from Interactive Broker saying like, your account has exceeded the margin limit, and we don't issue margin calls. We just liquidate your positions. Wow. And it was like, what the fuck is this? And that happened. It's like, what is going on? Because everything is out of the money.
Yeah.
And it's because this was the spike on the VIX, on the VIX, and then all the options were worth double or something. It's like
it was a massive...
my buying power was zero. My excess liquidity was zero.
Ouch.
So I had to close things, of course, at a loss. But that's the moment I realized when you need to sell things. In the moment the volatility spikes is when you need to start selling things.
And that's what I've pivoted to as well. Is like lean into volatility, don't shy away from it. So a lot of my experiences have been that happens. Like I have kind of come out of trades at the worst possible time, which is probably when I should have been entering the trades in the first place.
I know, but that was against your system, because then you have to be a volatility hunter. You have to wait until the hurricane comes, the thunderstorm comes, and then you come out. And while everybody's trying to hide themselves and take an umbrella, you just go out to go and try to get the lightning, right?
Yeah,
get struck by lightning. Now I go out.
Yeah, exactly. It takes bravery.
Exactly. But you need to have margin and excess liquidity and cash to do those things.
Exactly. That's what I'm saying. Be a risk management first.
And then
you feel like.
But then you need to wait every week and don't start selling like I do, like scale up. And it's because what happens to me is when volatility is low, the premiums are lower.
Mm-hmm.
So I get used to getting $1,000 a week. So now, because the volatility is lower, I need to sell more puts to get that $1,000. So I start scaling up when volatility is low, and that's the biggest mistake.
Right. If you're short options,
that's because basically I do short options.
Yeah, I think we're both basically fundamentally short volatility, which is really boring. But like that's what, after a year and a half or whatever it is of doing it, you kind of come full circle and realize that you can try every strategy under the sun, but ultimately the simplest one quite often wins. And
that comes with those 2, 3, 3, 1, whatever it's called, 1, 1, 2.
The 1, 1, 2.
The 1, 1, 2. Because if you see the graph of the 1, 1, 2, and I show you a straddle, it's gonna be more or less the same.
Yeah.
And the straddle is much simpler. It's just one put and one call at the money. And your thing, well, you need to buy a long put, then two, then one. So one debit spread, and then two more, just for you to lower that, to make the break even farther away from the spot.
I think we need to show it on the.
Yeah.
Can we do a screen share on this?
I don't think you can share the screen, or maybe you can. I'll share screen. But
let's look at the couple of these trades, and we can explain what we're talking about here.
Yes,
that's going to make more sense.
Okay.
So should we start with this then? This morning we were thinking about what's better, the Batman trade, and by the way, I'll explain why I think these two things exist at all in a minute.
Okay.
What is this one better, or show us the other one? Oh, it's a shame we can't have two in one screen, because that would make things a lot.
You mean the other one? Maybe I don't
do
know.
that and share the whole screen, not just a tab.
Maybe.
Yeah, like this.
I don't know.
Change that to 65% range.
65% range.
Just so there's like for like comparison. 65. Okay, there you go.
And then,
can we share?
Okay.
Right now we can only share these tabs, but can we share the whole screen?
I think we're sharing two things, this one and this one.
I don't think so. I think we're sharing that one. No.
Both. It says
compartiendo.
Yeah.
That we're sharing that one. We're not sharing that one.
It says both.
Oh yeah, you're right.
And we're sharing both.
Okay. Can I just see that then?
No, you cannot.
You
just screwed it. You're showing my things.
sorry.
You're sharing both.
I was trying to see the original. Yeah.
Okay.
So the question is, which one of these is better?
Then, I mean, for me, this is simpler. The short straddle is simpler. And if you see the break evens is 50, 65, and 73. And this one is okay. The break even is a little bit lower. It's true.
Yeah.
But so for $1.50, I don't think it's worth the complication.
Right. So the point is, this one seems better because it's got a lower break even and a higher break even. But it's got a lot more complexity. We've got 4, 5, 6 options here. So there's a lot to manage, and frankly, it's not really worth the juice. Is not worth the squeeze.
Because those points. So these little things, they only appear at the very, very end.
Yeah.
When there is 13 hours remaining.
And also, how likely is it that you're going to hit those
and that's what I mean. If you're going to close early, there's not going to be a huge difference. The only difference is like, if, for example, in my case with the leverage ETF, it's not going to stay at the spot, right? So probably it's going to move here or here. So in my case, for a leverage ETF, it makes sense if you believe it's not going to move that much. But this was still much simpler. You're going to see the right here is $400. And by the same price, this one is more or less the same. So at 55, this is 386, and this is 330 for a little bit more. So I know this is 3 days remaining. 3 days remaining.
I mean,
if at 55 is 420, and this is going to be 473. So I don't know if it's worth the complexity.
Interesting. So because this one says max or net credit 1135, and this one is this net credit 295, but max profit 795 versus 1135. You kind of think this one is better.
Yeah, but
actually it's so unlikely.
It's so unlikely to get hit, right?
We've got this nice middle section here where we're earning about 500, and this is probably better if you're going to.
Yeah, but this middle section, I mean, like what I said, like if you go to, for example, let's go to 51 or something, 200, right? And here is going to be 175. It's more or less the same for less complexity. I don't know. I mean,
the other thing we were talking about is managing at 21 days, which is something that you always hear about, but I think you've only just, I mean, you are actually actively living this manage at 21 day reality now, right? So it's more or less the same, not hugely different.
No, there's not a huge difference.
So the point about this is, I think these kind of trades exist because it's something for people to talk about. Psychologically, it's easier. It's easy to make a YouTube video on how to construct a Batman trade, which we would watch. I've watched those videos. So it's attention economy. So
see, look at 21 days, at 55 is 171 in the short straddle, which is the simpler strategy. 21 days at 55 is 151.
Right.
It's even less. Yeah. It's even less if you're going to manage the 21 days. And why do we do 21 days? Because Tasty Life says so.
Yeah, we believe in Tasty.
So if you close it at 21 days, it's better to just have the short straddle, which also is the book I'm reading, The Options Positioning of Sinclair, which is my new guru.
We're going to talk about that.
I haven't finished the book.
I think I'll read it too, and then we can dissect it.
You will probably go to Hot and ask him to make a summary.
No, I won't. I'm going to read it.
Okay, let's stop sharing.
I guess the point
go
is,
back to
I think that
where we are live streaming.
I would say the lesson I've learned or tried to adopt is 1, be a risk manager first, and 2, try and simplify everything. Because at one point I had all these positions open on loads of different underlyings, thinking I was clever, thinking I was going to be, and I guess over trading and getting excited and carried away. And most of those trades failed eventually. And the other pattern that I would do is I start trading a kind of a style or a what do you call it, like a strategy, like, oh, I'll do iron condors on a 1 DTE or something. And then as soon as it fails, I'm like, well, that didn't work. So I'm just going to walk away from that one and try.
Okay, you know what? After reading Sinclair's book, I'm not doing iron condors anymore or strangles.
No more strangles.
Because he did this Monte Carlo simulation with so much data, and even if they win more often, when they lose big, as opposed to a straddle or an iron butterfly, which is the protective version of the straddle. Because those ones, because you collect more premium, you have more margin of error with the straddle because you collect more premium. And then even if you lose,
because we're at the money, right? So that's where the money.
You lose more often than the iron condor or the strangle. Your max loss is much lower than the strangle, actually.
Right.
So it's a better risk management. But I'm not there yet with the risk management. I need to learn more about that. I'm more into for me right now, it's simplifying. Because I have this timetable with all my options spread out.
The famous spreadsheet.
And that looks like, it's like Tetris.
I know, you're moving one thing to
Yeah. I should talk about that another day. But I think for the first episode, it's fine. Is there anything?
We'll just allude to your spreadsheet. It's impressive. I also have my own tracker thing, which is.
But you don't sell as many options as I do.
I try and keep
not even nearly.
I used to, but not anymore.
And you only use one index, right?
One underlying, one option. I've stripped it back to.
I have 4 underlines, 5 underlines actually.
Yeah. And they're like friends. You get to know them.
Yeah. They're the big 5.
But the thing is about your friends, they're like the most volatile, crazy. You've got these like TQQQ, SOXL, TNA, and they're all
AGQ, which is the leverage ETF for silver. Oh. And now I started with S.
How's silver doing nowadays? I haven't seen it for a while. It's been out of the news for a few weeks.
It's I enter right when they went down.
That sounds
after
smart.
That big drop, and that is the only thing that's making me money so far.
So it's come back again.
No, it's because that's what happens with my strategy. When it trades on the side and it doesn't go crazy up or down, I collect the theta, right?
Got it. Nice.
Theta gang.
Theta gang.
Theta gang. But it doesn't really work when the market moves crazy like SXL.
Yeah.
Because at the 31st of March, it was so low and it skyrocketed to 130. And that really blew my margin and everything right now. That's why I lost everything. Because it just went to the moon.
Yeah.
And then don't sell calls when something is going up.
Well, this might be another misconception about trading, is that we all have inherently upward bias. But actually, with options, you don't need to. It could be, your strategy could work by the price remaining exactly where it is for the next year. And you could make a lot of money just
if it remains.
It's not about underlying gains, right? It's about getting the thesis correct, essentially.
Yeah, but the problem is the market. If the market is what is called path dependency, like imagine now XXL goes down again to the price that was at 31st of March in 2 months, but because it went up so high, my margin disappeared. I went to buy in power 0. I was forced to close the position. And then even if I was right in 3 months, I still, because of the movement that the underlying made during that time, I was forced to close the position at a loss. So there is a dependency on the path the underlying is making.
Right, it's not the fact that it ends on the same.
But that doesn't happen when you buy the shares.
No. If you own the shares, you don't have to worry about margin or anything unless you've bought.
So do not overtrade, risk management, and also
keep it simple.
Yeah. Keep it simple, stupid, no?
Keep it simple, stupid.
Yeah.
But the world of YouTube doesn't want you to keep it simple. I think that the world of YouTube.
Well, because you're sending those videos about the flygonal with 8 legs.
I know,
it's like, what the fuck is that?
I know, 8 legs.
I don't even understand the normal diagonal. which for me it's difficult to understand a calendar spread.
I used to
Just
trade
double
calendars as
calendar
well.
spreads. I don't
I
get them.
used to love a double calendar.
I
Did I
don't
make
get
any money
them.
out of them? No, but I love the theory about it.
Apparently, you have to do it when it's low volatility,
Yeah.
and then you make them at the little
it-
debit in the beginning or something.
Sure. Yeah, you pay a debit for it.
And
for a
then
calendar.
it's maybe because in my mind, if you pay a debit, then you're
You're
gonna
already
make.
down.
Yes, it's like in my mind doesn't work.
No, but in my mind, if you pay a debit, then that's probably the most you can lose, and I don't mind
That's
that.
a good one. That's a good.
That's why
one.
I like Leaps, because it's like, okay, I paid all this money, but I've got the right to the shares if I want them.
And now, for example, that's why I don't want to cancel my leaps right now to cancel all the calls of SOXL, because I got the leaps at 14 and it's fucking at 130.
So you still own the Leaps, you didn't convert it to shares.
No.
Okay.
I will convert it to shares because it's going to be.
But you've got all these short calls.
My short calls are killing me. They're killing me
My
softly.
I was thinking that Robin song where she's like, this bass line is killing me.
No, this short call is killing me because I sold too many short calls. The problem is I do short call spreads, and those are very difficult to manage on a leverage ETF because of the bid ask spread.
Yeah.
Because you always have to buy them at the more expensive and then sell them.
I think you're crazy, but
I know. I know, but the thing is, leverage ETFs are good for another strategy that I was doing before, which is the Licello AM Licello. But they're not good for overtraining. They're really definitely not good for scaling up or anything. So that's why I need to reduce my positions, especially because I was getting big wins 2 months in a row. So like my hopes were up.
So actually, tell us about this year.
So
you were doing very well earlier this year, weren't you?
Why? Because everything was going down.
You showed me your account, and it was like, look, Will, I made 20,000 this week. I was like, wow.
Yeah, because everything went down, and then or it went down a little bit, not much, and then my short calls were collecting all that premium. And then look at SOXL. It went from 45 to 130 in 3 weeks.
Is this most recent?
The semiconductors since the war of Iran and Hormuz and all those things.
It's crazy, right?
Now, who could expect? And people are saying, at least on YouTube, I cannot, of course, confirm this theory, but it's because there were so many short sellers that were forced to buy back
like a short squeeze
their positions, and there was a gamma short squeeze or whatever it's called, and that was the price. But it's not realistic. It's not because the companies are making so much money. It's just because the options moved the price up. And I was in the middle of the crossfire and I just lost everything I made.
So it's back to square one again for 2026.
Square zero, yeah.
I think you're lucky that you got away with it because it could have been a lot worse.
I know. Well, I still not completely. I still have the short calls that I need to close, but I can close them one by one.
Okay.
Because
I mean,
closing it makes my margin worse. So I have to wait for some options to expire to be able to close more.
Right.
It's an agony. It's a slow and agonizing strangling.
I think you're gonna have to demonstrate it using the option strat.
Well, but I don't know how the margin works in Interactive Broker. I just have to do trial and error. I close this and see if the margin goes up or down. If the margin it gets worse, I don't do that closing.
So you just sort of trial and error with margin.
I don't know how it works. Apparently, it has to do with deltas. Like for example, if you buy a straddle which are at the money, it's delta neutral, so your delta is 0. Let's say you sell the put and a call at 70, right? If it moves up to 75, one is going to be delta not 50 anymore. It's going to be 40 and the other one 60.
Yeah.
So then you have imbalance.
Right.
And now you have to do either buy the shares or sell the shares. I don't remember to cancel those things.
And I think that's what institutions do, right?
That's what they do.
To buy and sell, to balance.
They hedge those things. But institutions don't have this big bid-ask spreads or the transaction cost that we have as retail traders.
Yeah.
So I cannot be hedging my position constantly. And also what institutions do is like when the price goes up, they buy, and when it goes down, they sell, which is the opposite you should do.
Right.
But it's because they need to hedge the position.
Yeah.
They do those things.
Absolutely. Well, what about me? Since you asked, I haven't asked, but I'll tell you.
What about you? You made money this year?
I have made money this year so far.
Okay, so
But-
you're better off than me.
Well, I don't want to brag, but like,
Yes, you can brag.
No.
You can brag about it.
I mean, I think the game changer for me was not watching the underlying, but watching the volatility index that relates to the underlying, right? So I'm trading the Russell 2000 IWM, and it has its own volatility index, RVX, and you can watch that go up and down. And that's the thing I look at first, rather than looking at the actual stock chart. And as it's climbing, you can then think, okay, I'm going to sell an at the money or an in the money call. And that worked out quite well for me as volatility expanded, because there was more and more pressure to sell.
Will that work also with the small cousin TNA, the leverage ETF that I'm using?
I don't know, let's find out.
So how does it work? When volatility goes up, what do you sell?
You're selling at the money or in the money calls, because as volatility goes up, generally it's because price is falling of the underlying. But there's a nice trend going up. I can show you on the chart if you want to see trading view.
Okay. I have trading view here.
Oh yeah, you do.
Maybe we can share the trading view. Where were we? Here. No?
Yeah.
We have to go to share screen, and let's go to trading view. Where is trading view?
You use Grok. What do you use that for?
I don't know. Oh no, we need to use it. We need to use it here again. Yeah, sorry.
Okay. Just go search the top there. You don't need to log in. Oh,
you need to log in.
You don't need to, but you can log in anyway. So I want to see what indicators you have.
Okay, and now you go.
Second one down. This RVX.
We go to.
You can just
Supercharts here.
Oh, are you a paid member of this thing?
I'm not a paid member.
You never pay for any of these
things. Let's
things.
just share now.
Okay.
This one.
Should we start TQQQ?
No, let's go. Do you want to do what?
It's the second one down. Then.
Okay, yes, one.
See, see this. Look at this. I know hindsight bias and all that, but basically, this was a really, really strong trend upwards in volatility. I couldn't believe it, because every time we were going up, the price of the index was going down.
Let's see. This is the IWM.
Yeah.
So this was going up.
Is that the same time period though?
From
December to April. Volatility was going up.
And from December to April, this thing is going down.
It was this basically. Yeah. This trend basically.
And you were selling there at the money calls.
At the money and in the money.
And it worked.
It worked, and it protected my underlying leaps.
What about now?
Well, I was still selling them around here, and I had to pay my short calls. I had to pay a debit to get my short calls back. But then I left it uncovered, and I've managed to be disciplined enough to be uncovered through.
What about selling puts then?
I don't sell puts.
Okay.
I used to sell puts, but I don't. You're right. I could have done.
All right.
But I just allowed the leaps to kind of gain value, and we've had this kind of consolidation now.
And now what are you gonna do?
I sold a call, but I bought it back for 50%. Fine, and now I think, according to volatility, if you go back to RVX, what's happening? We're going back down again. So we went up, and now we're going back down again. So, but you know what they say about technical analysis,
right? So when it goes down, you let it uncover.
I'm now uncovered because we're falling.
Okay.
I think we're going to revert back to this sort of level. And then once we stabilize, once the volatility stabilizes, my plan is just to sell out of the money.
So this is TNA, which is more or less, let's do TNA divided by.
What do I call TNA?
Is this the?
What are you doing?
I'm doing the.
I didn't know you could do that.
Ratio of both.
What? You don't have to pay for this?
Not really.
What do you mean ratio? How does that work?
Well, it's dividing the leverage ETF by the underlying.
Bloody hell.
Or you can also do it this way. Look, if you want, we can just do this and then put these, what is it called? I mean, you can have the indicators. You can add here IWM, and then you see it as a line, and you can compare both.
Okay. So which one is which? That blue line is IWM?
And that's the real one.
Wow.
And this is the leverage ETF.
Gosh.
Gosh.
Yeah.
One of the reasons I'm using a leverage ETF is because it's cheaper and it gives more premium. because the volatility is higher.
Cheaper and gives more premium. Okay, yeah, sure.
But they have this what is called volatility drag, which means in the long run, they tend to go down, which is not happening right now. That's why
and that's because it takes more to climb back up to its previous level.
Yeah, because they're actually calculated on a daily basis. They calculate a triple. If it goes up 1%, it's going to go up 3%. But if it goes down 1%, it's going to go down 3%.
Okay.
Right. So if the underlying goes down 1%, so in this case the Russell, the TNA will go down 3%.
And then it's harder for it to go back up to.
Because to go back up, it needs to go like 4% or something. So not 1%. 1% will not be enough for it to go back up. So it goes slowly down. So then you get more premium because it's more risky. And that's why I'm always making so much money. But then at the same time, you lose much more money.
Yeah, it's like high risk, high reward.
Exactly.
That's
I would say like triple risk, high double reward.
You can see it here actually. Look, as we declined, this
declines
leverage
way
really
more.
went down to down 58% as opposed to
exactly
20% of the underlying.
Exactly, which is good for the other method, the Licello.
Do you look at RSI?
I look the RSI compressed for Licello.
Okay. Let's tell our listeners what Licello is briefly.
Well, it's one guy that died a few years ago, and he created a mathematical system to.
In what year did he create this?
It's 1974 or something, or 73 or something. But we will talk.
And it's kind of fallen out of fashion, right? It's not.
No one knows about it.
I hadn't heard of it until you mentioned it.
But I think we should talk about it later because
another time.
Because I think it's been long enough for a pilot episode.
I don't think anyone's going to watch this, but
46 minutes.
We might have some material that we can edit in to make it.
Maybe you just wanna download it and try to edit it. That's fine.
The audio.
You're gonna make me glitch. Cutting my tag words and
can edit out some filler words.
Yeah.
And maybe compress the. Have we stopped?
No, I haven't. Do you want me to stop it? You just need to.
What are we going to talk about next? What are we going to talk about next time?
Maybe we can talk about Licello.
Next time on the podcast.
Licello time.
Licello time.
But you will be in another city.
I will be in another city. Yeah.
So we'll see how we can do it.
I think it'll be the same, except we'll be on 2 screens, not 1 screen.
But we cannot do it on YouTube directly, and we need to use another program.
All right. We can cross that bridge when we come to it.
Right. Perfect. You can ask Claude today. Your mentor.
Why are you teasing me about that? You use ChatGPT as your not only your mentor, but your boyfriend.
It's like my lover, my friend, my mentor, my psychologist, my consultant. It's everything.
Did I tell you about that podcast about it's called Artificial Intimacy, and it's all about people who use AI for like replacement lovers.
Okay, I could write a blog about it.
It's interesting. It's really interesting. Recommend.
All right. So
okay.
I don't think anyone is watching, but anyway, if anyone just came across this video and lasted till here,
kudos to you.
Thank you. And if you have a problem, probably go check yourself out with psychologists.
Maybe some of your patients watching.
I don't think so. They don't speak English.
But we didn't tell people what you do in real life.
No, but just keep it away. Leave it like that. Yeah.
I'm not going to tell you yet.
No. Bye bye. All righty.
All righty.